Recently, Coforge announced its acquisition of US-based software engineering firm Ancora for $2.35 billion. In FY25, the export of software services by Indian companies totaled $205 billion. Outbound mergers and acquisitions accounted for over 25% of total mergers and acquisitions in 2025. These are just a few examples of Indian companies crossing borders for expansion. Now, given India's fast-growing economy and rising influence on the world stage, it wouldn't be surprising that the next global giants are not from Silicon Valley, but from India. And for you as an investor, the opportunity lies in identifying companies that are rapidly expanding their foreign footprint and thereby becoming global in nature. Hello and welcome to ET Money's YouTube channel. In this video, we will discuss why it's important for you to consider investing in companies that are going global and how you can go about doing so. This video is the second in our series of decoding India's economic trajectory and how you can profit from it as an investor. In the first video of this series, we discussed if India's economic growth will soar over the next decade. Do watch it to gain deep understanding of the nuances of the Indian economy and move beyond just the headlines. Alright, let's first start by understanding why it's important to consider companies that have global ambitions. So why does it matter for you to look for companies that are expanding globally? This question is important as India's own economy is enjoying strong tailwinds and domestic demand alone would be sufficient in many cases. What's more, even foreign companies are looking at India for growth, so why should an Indian investor worry about companies going global? The first reason is that such companies align well with India's strategic geopolitical shift and its drive to become a global economic powerhouse. With India becoming the fourth largest economy in 2025, and given that India is home to 18% of the world population, India's weight in the global economy is rising. India is leveraging its economic potential by getting into trade deals with other countries. In December 2025, India entered into a free trade agreement with New Zealand. This was India's 18th FTA. India has FTAs with European EFTA countries, Japan, South Korea, Oman, Australia, etc. Now, these FTAs are especially crucial against the backdrop of tariff war started by the US. They provide Indian companies convenient gateways into overseas markets. The second factor favoring global expansion is saturation in certain pockets of the Indian markets. For example, according to IBEF, India's tele-density reached 86% by 2025. That may limit growth via subscriber addition. Other consumer-oriented sectors such as auto, FMCG, and consumer durables can also face a similar situation as the penetration of their product increases. Amid this, expanding to global markets becomes essential to bolster sales and profit growth. Now, to find greener pastures overseas, in July this year, Tata Motors announced its acquisition of Italy's Iveco. This acquisition will give the company a foothold in the European commercial vehicle market. Third, by their very nature, certain sectors rely heavily on overseas markets for a significant portion of their business. The obvious example here is IT. However, the pharmaceutical sector also derives a significant portion of its income from overseas markets. In FY25, the pharma sector exports stood at $30.5 billion. Now, the importance of overseas expansion for such sectors can't be understated. Fourth, overseas expansion can help boost margins via premium pricing, cost synergies, and higher value clients. This can in turn benefit investors via better investment returns. And finally, overseas expansion can help Indian companies diversify their revenue streams and lower vulnerability to domestic policy shifts. Now, at the portfolio level, this can help reduce risk for investors. Of course, overseas expansion has its downsides too, and we will discuss them towards the end of this video. For now, let's take a look at ways to pick promising companies expanding globally. But before that, here is something important. Many of you come here for kind of mutual fund analysis you rarely see elsewhere, rolling returns, downside protection, and so on. But knowing how a fund behaves is one thing. Figuring out how to use that information in your investing decisions can be difficult because each of us have our own risk comfort and goals. That's exactly why we built ET Money Select. It's a personalized shortlist of funds that stands out from 2,000 plus mutual funds, not just on returns, but on how consistently they deliver and how well they protect when markets fall. The list is personalized to your risk appetite and gives you funds for long, medium, and short-term horizons. And for every fund, you get a simple note explaining how it invests and what drives its performance. plus an alert if the fund starts to dip or a better alternative is found. The first and most straightforward way to pick companies that have a meaningful overseas presence is to track export revenues as a percentage of sales. This can in turn be done in two ways. First, you can pick companies that have a higher share of exports as a percentage of their total revenue. Second, you can select companies whose share of exports as a percentage of total revenue is growing. Here are India's top 25 exporters from the BSE 500 group of companies in terms of export revenue as a percentage of sales. Now, this list is not surprising as most companies belong to IT and healthcare sectors, which are export oriented in nature. Still, the list throws up some interesting names in the business services space like Latent View Analytics. However, even these companies have tech and pharma linkages. Indigen provides digital solutions to global pharma and life sciences clients. Biocon subsidiary Syngene is a CRDMO whose revenues naturally originate from overseas clients. And Latent View is again an analytics/AI services firm. So to get more meaningful list, let's exclude IT and healthcare companies and the three business services companies that we just saw. The refreshed list is on your screen now. The top names in the list now includes Samvardhana Motherson, an auto ancillary company, Swan Corp, a textile company, and UPL, a chemical company. This is a more diversified list as far as sectors are concerned. Still, two sectors dominate the list: automobiles and auto ancillaries and chemicals. So apart from IT and healthcare, you can keep these two sectors on your radar too as far as overseas exposure is concerned. Next, let's take a look at companies whose exports as a percentage of revenue has been rising over the last 3 years. In the BSE 500 companies, we found 29 companies whose exports to sales ratio has improved in each of the last 3 financial years and whose FY25 exports to sales were at least 25%. Once again, many companies belong to IT and healthcare sectors. If we remove those names, we are left with just 12 companies. These include Aarti Industries from chemicals, Godfrey Phillips from FMCG, KPR Mill from textiles, TBO Tech from hospitality, and so on. Now, one important thing here, none of the companies in the list shown to you are our recommendations. The idea is to just highlight the names which are driving a large part of their revenues from exports and hence are good prospects to profit from the theme of companies expanding overseas. You can use this list as a starting point for your further research. Do check the business, financials, management, and valuations of these companies before you invest in them. Alright, next let's take a look at some other ways in which you can find companies expanding globally. First, as we saw, certain sectors have a higher overseas orientation than others. These include the IT, healthcare, chemicals, and auto sectors. These sectors can be a good hunting ground for companies expanding globally. Alternatively, you can consider a sectoral ETF or an index fund with a basket of such companies. Second, whenever you research a company, you can take a look at its global presence and expansion strategy. For instance, in its annual report for FY25, Bajaj Auto outlined its strategy and numbers for international business. The company said that its exports rebounded to double-digit volume and revenue growth. About a third of the company's sales come from exports. The Latin America region saw the highest ever motorcycle sales, and so on. The point is to glance over the annual report to assess a company's overseas expansion strategy. You can add this as a criteria in your overall research framework. Third, track overseas corporate mergers and acquisitions to find companies that are taking the inorganic route to overseas markets. Tata Motors' acquisition of Italy's Iveco, Bharti's acquisition of BT Group PLC, Coforge's purchase of Encore, Zydus Life Sciences buyout of Amplitude are some recent examples. Last but not the least, stay updated with business news and developments that can not just tell you about the latest corporate trends but also widen your overall investment perspective. That said, overseas expansion is not free from risks. So what are the challenges that it can create? Let's understand them in the next section. While investing in companies pursuing overseas expansion appears to be appealing, as an investor, you must also understand the risks associated with overseas expansion. It's important to evaluate such companies against this risk too, and not just the potential that going global has. The first risk of overseas expansion comes from the unknown. While any company would do its homework before venturing out abroad, there still remains a healthy uncertainty. This uncertainty can arise from legal, regulatory, cultural, social, and region-specific factors. For instance, in 2013, Ranbaxy had to pay a penalty of $500 million to the US government. Ranbaxy was later acquired by Sun Pharma. Integration of foreign staff and understanding foreign preferences can take a while and can be a source of friction for the foreseeable future. Companies like Marico, Imami, and Godrej experienced this when they ventured into Africa. The second risk originates from the debt burden a company may have to take for an overseas expansion. A good example of this is Suzlon Energy, which took massive debt to fund its purchase of RE Power, later rechristened as Senvion. Due to its heavy debt, the company faced near bankruptcy. Now we discussed Suzlon's story in one of our earlier videos. I've included its link in the description so you can watch it later. So, if you're going to bet on a company that is making an acquisition overseas, do check if its debt burden will rise due to this. If yes, how serious can the problem be? Don't completely go by the management's view on this. The management often sounds upbeat about acquisitions, so take management commentary with a pinch of salt. The third risk originates from global and geopolitical factors. Asia, Africa, Middle East, Latin America are hotspots of geopolitical tensions, and business exposure here can quickly run into danger. Adani Ports, which owns a port in Israel, faced the heat when the Israel-Hamas war broke out in 2023. Tata Motors' European operations face a similar situation when the Ukraine-Russia war erupted. Now, amid the ongoing systemic breakdown in Bangladesh, Indian companies' exposure to Bangladesh could become a pain point. Now, apart from this, other risks related to overseas expansion include currency fluctuations and forex risk, cybersecurity threats, demand forecasting, pricing missteps, etc. Last but not the least, the more spread out a company is, the more its moving parts. As such, it gets difficult to analyze such a company and make reliable forecasts. As a result, such companies can frequently throw both negative and positive surprises, which keeps making investors' life difficult. Now, given the opportunity and risk, how should you approach investing with companies with global ambitions? Let's discuss this in the concluding section of this video. At the portfolio level, investing in companies with a significant global contribution or exposure can be a good diversification strategy. It can even be seen as a variant of international diversification in portfolio, especially at a time when most international funds are closed for fresh inflows. However, it also makes sense to assess the global exposures. Exposures or exports to developed markets are comparatively less subject to uncertainty than those to the developing world. Asian, African, Middle East, and Latin American markets offer growth but at a higher risk. At the company level, to ensure that the acquirer is not getting neck deep into debt to fund the acquisition. With this in mind, you can carefully pick companies that are riding on international growth. As India shines on the world stage, it's only natural that you should have some bright stars in your portfolio too. And with this, we have come to the end of this video. I hope you found this video useful, and if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.